Many of you have enjoyed my SoFi video here on YouTube and you asked me to review a few more growth stocks on the channel. So I decided to do that today and talk about three growth stocks trading near their lows and just do a quick update, a quick overview and give you my opinion on them. And I hope you enjoy it. Those were highly requested stocks, very popular stocks on YouTube. And before I get started, I always like to mention that with the growth stocks, it's not much about, the free cash flow yield. It's not much about trailing earnings or the last 10-year earnings or whatever it is. It's more about the future. It's a lot of speculation. It's all about the ifs and what if this happens, what if that happens. So I always try to tell people is the best way to limit your risk is by having the right position sizing when you don't put in a lot of money in them, because if you're right, your upside is unlimited. You don't need a lot of money if that stock goes up 10, 20, 30 times. But if it doesn't go up that much, then you don't lose a lot of money. And that's how I think about them. And I hope you enjoyed the video. The first one, and this is by far the most popular one on YouTube. A lot of people love this one. And this is New Holdings. It's down 30% from its all-time high. It's sitting at $11.14, the same price it was trading at in early 2024. This is a very interesting one, guys, I have to say. It's mainly a digital bank or an online bank, kind of like SoFi, but much, much bigger. Over 110 million members. Just look at this chart. It's insane. They mainly operate in Brazil. Then they started in Mexico, and then they started in Colombia, I believe, in late 2020, and they've been expanding. 110 million members. That's that's very surprising, amazing stuff. Over 20 million members year on year, they're growing. So the growth has been amazing for the company. You look at deposits, most of it is in Brazil, and this is one of the reasons why the stock has been weak, because the situation in Brazil hasn't been the best, and I'm going to talk about that a little bit. That's why the stock has been weak. And it's not just this one, Mercado, I talked about it, has been weak. You have STNE, StoneCo has been weak. You have PAGS has been weak. So many other companies in Brazil have been very, very weak. And a lot of value investors are buying stocks over there. But you look at Mexico, it's the second largest one. Then in Colombia, they've been rapidly expanding, and they just got into it not long ago. And they've been expanding rapidly. That's very good. Revenues massively growing, 56% growth. It's been growing every single quarter. Gross profit, 46% gross profit margin, very high margin business. And it's been growing every single quarter. Net income, everything has been growing almost on a quarterly basis. It's like you're drawing a chart. It's beautiful, beautiful business model. Everything looks very good. Even volumes have been increasing, 21% year on year. And the question is, if it looks so good, if everything is so amazing, why is the stock has been such a disaster as of recent? Why is it down 30% from all-time high and it's been struggling over the last few months? Well, there's a few reasons. The first reason is the currency in Brazil hasn't been the best. You look at the Brazilian real, it's down 21.5% over the last year. And it's not just the real, but a lot of those currencies against the dollar. The dollar has been extremely strong. When the dollar is very strong, a lot of those you could say emerging, I shouldn't say emerging market, but I should say, foreign investments, they're not favored by a lot of market participants. They start selling them and they get discounted in valuations. And you could look at the valuation in Brazil. The entire Brazilian country, in terms of the MSCI index, is trading at 6.9 times forward PE. 6.9 times, this is very, very low. The mean, I believe, was like 11 or 12 times. It traded as high as 18 times, and now it's trading at 6.9 times forward earnings. And it's not just Brazil. You look at Mexico, you could even the UK. The UK is very discounted. You can look at a lot of places. This is what happens when the dollar goes up. A lot of those countries and other foreign investments, they become less attractive. But the dollar can't keep going up forever. And once the dollar starts pulling back, a lot of those investments are going to look very attractive, and they will likely perform very, very well. But those are two of the reasons why the stock has been weak and the economy hasn't been the best in Brazil. And of course, there's competition from Mercado and there's competition from other companies. And I would say I wouldn't be surprised if Mercado ends up buying a lot of those smaller banks that are struggling right now in Brazil. That's what I would say. But looking at the valuation of the company, It's trading at 19.7 times forward earnings. This is very cheap. The mean was 26 times. It's trading at 19.7 times. In my opinion, this is very, very cheap. And looking at the forward growth of the company, it's expected to be much, much faster. It grew around 82% in 2024 in EPS. Next year, expect to be 41%, then 39%, 42%. Even if half of those numbers are right, at 18, or I should say 19.7 times earnings, it's very, very cheap. So I would say Nu Holding, just looking at it at a just overview, this is what I'm doing. I'm not doing a deep dive. Looking at it at an overview, I mean, it's very hard to lose money over here. I'm just being honest. The main problem is the discount of those countries can always get wider. Now, looking on a historical average, it hasn't really gone much below 6 times. I mean, in 2008, it went to like 4 times. So there's not much downside, at least on a historical basis. But those kind of stocks, they can kind of always get cheaper. I mean, look at Alibaba. They did everything in China, buying back stock, doing everything you want, dividends, and the stock is still not getting a multiple expansion. So sometimes, even though the company is performing, everything is doing fine, the geopolitical risks can price in such a multiple contractions that it could potentially be permanent. So this is the main risk, I would say. But if you have a high risk tolerance and you're willing to wait maybe a year or two of no returns potentially, if it doesn't bounce back very quickly and you have a lot of patience, I mean, to me, it looks very good. I would say Nu Holdings is a buy. As a small cap foreign bank, it looks very good. And there's always risks with them in terms of what's on their books, any change in regulations, and many different things. I don't own it personally. I don't like to invest in banks too much. But to me, Nu Holdings, doing a quick overview, looks like a very good opportunity in a very hated, unjustified situation. Okay. Now, the second one, which is more in the United States and it's also expanding internationally, is Block, SQ. This was a very popular one. It went as high as $270 back in 2021. Now it's sitting at $86. You have this line. It's been bouncing off this line, and it's still trading at the same price it was trading at in 2018. So the stock has gone nowhere for the last 6 or 7 years. And that's why I put it up in the video, trading near its lows. And in my opinion, this is a very interesting one. A lot of you guys are familiar with SQ. They own the popular Cash App. Cash App has been a beast. And they own the Square platform, which is also rapidly growing within merchants and many different things. And they did buy the Buy Now, Pay Later platform. It was a very popular one. They bought it. And they're expanding rapidly in the space from consumer kind of banking to other merchant banking and other kind of things. And they're benefiting a lot from digitalization and everything going online. And the Cash App is the most popular one amongst younger people. And it's been a beautiful one. Looking at Cash Apps, they have 57 million active users and a lot of inflows. They're monetizing them by advertising, buying and trading cryptocurrency on Cash App, having, I believe, a Cash App debit card or something, and kind of like what Robinhood is doing with their broker. Cash App is doing it with a payment app. It was very smart from the company, and they're doing well with it. Over $70 billion in Cash App inflows from an app. I mean, that's huge. Looking at gross profits, it has been getting very profitable as of recent. It's been an inflection point for the company from $1.8 billion to $1.3 billion. And it looks like it's going to keep getting better. Now, looking at the valuation of SQ or Block, I should say, is trading at 20 times forward earnings. Now, the mean was 90 times. It traded as high as 324 times, as low as 14 times, and now it's trading at 20 times forward earnings. But you have to know that it's not really trading at 20 times forward earnings because of stock-based compensation. And you look at stock-based compensation and the difference between GAAP and non-GAAP. This is based off of $4.59. By GAAP EPS, which takes into consideration stock-based compensation, is like almost 40% of that. It's like $2.65. So it's not really trading at 20 times. It's trading maybe at 30, 32 times minimum. I could put up the number on the screen. But yeah, it's not as cheap as it looks. But on a non-GAAP basis, which is now the most popular metric on Wall Street, it's at 20 times earnings. And I always said that I prefer something like a PayPal over Block, and it has outperformed Block. But Block over here, I have to say, it does look very interesting. I'm going to do just a very quick valuation model on the stock, just based off the numbers that I have. And I'm going to take $7.60, which is a non-GAAP EPS expected for 2028. I'm going to time it by 20 times earnings, which is a current multiple, which would be fair in this case, counting in no multiple expansion or contraction. And I believe the growth is fair. It's not expected to grow rapidly, 17 to 18%. I think that's fair. I would get around $152 per share for Square. The current price for SQ, I believe, is around $86.75. So we're going to divide it by $86, an example. I'm getting around 76% on the upside. 76% on the upside on SQ over the next 4 years. To be honest, this is really not bad at all. But if I had to buy SQ personally for SQ, I would pay half $152, which would be around, around, I would say $76, $77. So if SQ gets to $77, $76, anywhere below $78, I think it's much more interesting than it's trading at right now. But even right now at $86, I could see 76, 77% on the upside on the base case scenario, not pricing in a multiple expansion and not pricing in anything else. I believe there's better opportunities in the market, but Square over here doesn't look too bad. Nu is much better, I'm just being honest, but Square doesn't look too bad at all. The last one, and this is the most hated one, it's Enphase. Enphase is still trading at the same price it was trading at in 2020. It's been a disaster. A lot of things are changing with the company. A lot of you guys are familiar with Enphase. They're popular for their microinverters. And they've been expanding beyond just microinverters and batteries and other kind of home solutions. And they've been able to capture a larger percentage of the home. And the company has been rapidly expanding, rapidly growing. And solar is, you could say, has been a little bit cyclical. And a lot of those solar stocks, after being loved and being bid up to the stratosphere, they have taken a massive hit. And I believe a lot of them are looking very interesting, especially First Solar. First Solar is looking very interesting. And I'm researching the stock, I'm being honest. But Enphase is not too bad either. And it looks like things are finally turning. It's been very ugly for Enphase's earnings. It's been, if you look at non-GAAP EPS from $1.04 to 43 cents, it's been declining a lot. But it did take a major shift in Q3 of 2024, and it went from 43 cents as of Q2. In Q3, it was 65 cents. Now, that's a major shift, a major inflection point. And if it continues on this track, then, maybe we could say that the worst is behind Enphase, and it's going to get much better from here. Now, in the United States, they did increase 43%, but in Europe, they did decline 15%, or their revenues decreased 15%. And they said it's due to some kind of inventories and a few other things that they had. And there's a lot of uncertainty. For example, the new administration, they said they want to pull away the EV tax credits. But as they also going to pull away the solar tax credit, we don't know yet. They did not mention anything about that. But if they decide to do that, this could be really bad for Enphase. So this is another major risk that a lot of people are not thinking about. And if it does happen, in my opinion, this is a major risk for the company. And the only market that's growing in the United States, 43%, it could be very bad. But it looks like it's needing an inflection point, and things are starting to get better quarter on quarter. And this is very good for Enphase. Looking at the PE ratio, it's sitting at 20 times earnings versus a mean of 50 times. It traded as high as 124 times and as low as 17 times. Now, I have to be honest, guys, it's not trading at 20 times earnings again. You look at the whole setup with stock-based compensation, it's the same thing. It's huge for the company, 227 GAAP versus 379 non-GAAP. So it's not trading at 20 times. It's trading over 30 times, I believe. I could put up the number on the screen. But this is what's happening with the company. Looking at the EPS expected growth, it's expected to grow 74% next year. I believe this is fair because after the company decreased 15% and 2023 was weak, it also went down 4%. I mean, I could see a 74% year. This is normal. I could see that. And after that, they're expecting 25%, then 31% and 23%. I'm not too sure, guys. I believe this is a little bit optimistic. Especially as we don't know what's going to happen with the solar tax credits and a few other things that could change with the new administration that doesn't seem too bullish on clean energy. in terms of solar. That's just the way I see it. But we can also do another quick calculation. We could take $7.75 and we could time it by 20 times earnings, assuming no multiple expansion and contraction. This is 155. The current price of Enphase is $69 per share. I could divide that by $69 per share. I would be getting around 124% on the upside over the next 4 years if those estimates do hit. So Enphase, looking over here, just on a basic quick calculation, it does look like a buy, like a speculative buying position, like a small position. If it does work out, it's amazing. I could see the upside if the estimates they do hit, but you still have a lot of uncertainties with the tax credits, everything else. The company is buying back stock. They have a good balance sheet, good management, very smart management. They're expanding internationally. So it does look very good, I have to say. But for me, if you look into First Solar is looking much better. I like First Solar much more. But Enphase over here, if I had to say something about it, I would say it's looking like a decent speculative buying opportunity. I would not put my life savings into Enphase or Nu or Block or any of those stocks. This is not Google or Amazon or anything crazy. And this is what I would say. It does look very good. And my favorite one, I believe, is Nu Holdings, as it's very cheap, and I don't know how much worse it could get, but it's looking very good. And this is just my opinion on those stocks. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.